Welcome back, everyone. Michael here with Offshore Citizen. Today I'm going to discuss the subject of corporate governance, and I'm going to do so in a way that I think is useful because it contextualizes an area of crypto where they've kind of made some changes and not gone in the direction. They've kind of forgotten about some of the lessons that have been learned in the corporate world. And I sometimes talk to people about this. You might think corporate governance, what a boring subject, right? But it's really relevant from the standpoint of management and control rules, sometimes in the sense of controlled foreign companies or various different other rules in terms of figuring out how do you manage your company properly so that you don't violate a set of rules that might inadvertently create tax consequences in another country, might expose you to asset protection, liability risks, et cetera, et cetera. So I wanted to go through that with you and use this example from the crypto world to maybe discuss what you should be paying attention to in your company. And I think it's something that intuitively as small business owners, we don't really get. And the reason for this is because we tend to view our company as an extension of us. And sometimes, if you're a sole proprietor, a sole trader, something like this, it is true, right? It basically is an extension of you. But when you set up a corporation, technically speaking, that is a separate legal person. And that separate legal person bears with it a certain set of responsibilities. And if you want to optimally protect yourself from the liability of the company, this is something you should understand. Further, if you want to end up in a situation where you can have an international structure with multiple companies, it's really, really important to understand this because otherwise you can trigger all sorts of hassles and nightmares. And so you might say, hey, we should have proper corporate governance. People are like, what the heck does that mean? So we're going to talk about it right now. Before we do, if you haven't already, please hit the subscribe button, nail the notification bell, hit the little all notifications. If you haven't already, make sure you don't miss out on any of our videos. And please, if you would like help with any of these subjects of international tax optimization or setting up companies, opening bank accounts, getting residencies and citizenships, and asset protection, please reach out to me. You can book a call, calendly.com/Michael-Rosmer. There's a link in the description below, or send a message to our websites, offshorecitizen.net or offshorecapitalist.com. Okay, so here's the kind of history of the crypto example that is relevant. Okay, so something has started to happen, which is in retrospect very predictable, but the world of crypto has a lot of what I would call idealists. And so they created this concept called DAOs, decentralized autonomous organizations, which the theory is nobody really owns them, but they often have a governance token. And so people can buy the governance token and they can gain votes for it. Now, if you go back to the history of the founding of the US, you'll find that the founding fathers considered direct democracy and actually discarded it. They figured that it would create what they called a tyranny of the majority, okay? And so they created this representative system. Now, there's a bunch of reasons historically why a representative system made sense aside from that, such as the geographic constraints of trying to have everybody vote. So it made more sense that you would have a representative in California who would just come out to Washington, D.C. and be there representing you and vote on your behalf, as opposed to having the people vote on every individual item. But in corporations, we have something similar, right? We don't tend to have direct governance. What we have is that the shareholders elect a board of directors. The board of directors then selects the executive team, and the executive team runs the company, typically with some oversight from the board as well as board involvement in certain decisions, for example, a major merger acquisition, something like that. So what happened when it came to DAOs is they just went to direct democracy. They had this somewhat naive belief in democracy and, hey, let's just have people vote, one token, one vote, etc. Well, what's the problem with this? Turns out that a lot of these projects have developed big treasuries, in some cases over $3 billion. And what started to happen now is big VC firms who control large voting blocks are in a position where they can propose projects that should be granted money, and they can vote for those projects and essentially pull the money out of the treasury, which is creating some controversy, not really unjustly, but it was poor thinking on the part of the people who designed it not to look at it from a game theoretic perspective and architect this to kind of stop those barriers. And this brings us to proper corporate governance in the corporate world. So when it comes to companies, what is distinct here? See, you can't really go after somebody for voting in their best interest as a shareholder or as a token holder. Makes sense, right? But what they would do is they would create rules that protected minority shareholders, and the directors of the company are legally bound. They have a fiduciary responsibility, which, by the way, comes into play a little bit when one of the things that will often happen when you set up an international structure is you may have to form a company abroad, and that company abroad you may end up having to hire some foreign directors for. And people will say, well, hang on, aren't there risks of this, et cetera, which of course, in a bare sense, yes, there are, but there's a lot of legal protections against that. Being a fiduciary, a licensed fiduciary, is like a really serious thing, and violating your fiduciary duty as a director of a company is also a serious thing. So directors have a legal obligation to act in the best interests of the company and by proxy the shareholders, and to boost shareholder value essentially. So if they play favorites and kind of loot the company on behalf of a particular group of directors, well, they can be legally responsible for that. And this is something that sways them to protect the minorities involved. This doesn't exist in a lot of these DAOs. In fact, I don't know of a single DAO that is the case, which is really kind of disturbing. So anyway, the whole point of how this applies to you is understanding that if you have a company that is abroad and you want to say, hey, listen, I want to have foreign management and control for this company. What does that mean? That means that the way that a foreign director would behave, the types of things that would protect the interests of the company, not necessarily the interests of a minority shareholder or even in a sense a majority shareholder, should be upheld. Okay? On top, some of this would include not treating the company as your personal bank account. Some of this would include not commingling funds between either shareholders in the company or between multiple different companies, etc. At big, huge public company level, I mean, they have specific lawyers who they'll consult on these issues to make sure that they're not going to put themselves in a tough situation from a director's standpoint. And so treating an entity as its own thing and acting in the best interest of that entity becomes a really, really important issue in managing these companies and making sure that you can optimize and kind of like sequester the tax liabilities for a given entity in that country and not have it spill over to another country. The same thing is true from an asset protection standpoint. Okay, if you want to maintain the protection of the corporate veil, it's really important that the corporate governance is maintained at that level. It doesn't get treated as what they call an alter ego of the shareholders, so that the liability can't spill through. And if you do it properly, it's worth noting that no US public company has ever had the corporate veil pierced. So that's arguably because of two factors. One is the structure of public companies and sort of the oversight that they get tend to ensure a high degree of corporate governance. The second reason, of course, is that there's many, many shareholders, and it's very difficult to attribute responsibility to a particular shareholder based on that. So all things that are worth being aware of. So I hope that helps. I hope it gives a little bit of background on this environment and what's happening in crypto, which is kind of sad, but hopefully presents a lot of opportunity for innovation. And at the same time, how that applies to you from an asset protection standpoint, from a tax standpoint, and just from a general good best practices for running companies, especially when you have like a corporate structure, multiple legal entities. Hope that helps. If you have questions, put them in the comments below. Look forward to hearing from you. Feel free to reach out if you have questions or if you'd like help with something. And I'm going to look forward to seeing you guys on the next video.